Sales tax audits can feel like they come out of nowhere. So how do you prepare, and what do states look for in these audits? States do monitor certain patterns and data points when deciding which businesses to review more closely. Filing history, reporting trends, and visible activity inside the state can all play a role in whether a business gets selected for an audit. In this video, we'll walk through the areas states tend to focus on and what you can do to prepare long before an auditor reaches out. But first, why do sales tax audits happen? Before we dive into what triggers an audit, it helps to look at the process from the state's perspective. For states, sales tax is a major source of revenue. Audits are one of the tools they can use to verify compliance and ensure that businesses are collecting and remitting accurately. Audits aren't about targeting specific companies. They're part of the state's broader system for validating that what's being reported aligns with what the state expects based on the business's activity. Each state's approach varies, but there are consistent patterns in what tends to draw attention. Here are the most common areas. First, states actively look for businesses that seem to have nexus, meaning some connection that creates a sales tax obligation, but aren't registered or filing returns. They look at indicators such as marketplace activity, shipping and fulfillment patterns, employee or contractor locations, public business records, online activity, wholesale or resale relationships, and industry norms for similar companies. If a business appears active in a state but has no sales tax registration, that can prompt outreach or further review. Second, states look for incorrect or incomplete filings. States don't have access to your underlying sales data before an audit, but they do analyze the information you report. They look for filings with incorrect local tax components, wrong tax rates, patterns that don't align with typical business activity, frequent amended returns, repeated $0 filings despite signs of activity, and incorrectly completed form. These discrepancies stand out when the state reviews filing history. Third, states monitor filing trends over time for illogical or highly irregular reporting patterns. Patterns that fall far outside what they'd expect for a small business tend to get noticed. For example, if you consistently file around $10,000 in taxable sales each month, and suddenly file $200,000 one month, and then return back to $10,000 the next, that kind of sharp swing tends to stand out. Auditors pay attention to unusual spikes or dips, activity outside normal seasonality, trends that don't match how the business appears to operate, and sharp changes that fall far outside expected norms. These patterns don't imply wrongdoing, they simply tend to prompt a closer look. And fourth, states track filing behavior closely to see if there are filing gaps or missing returns. Some associated red flags include missing returns after consistent filing activity, filing late repeatedly, long stretches of $0 filings, and filing gaps without clear signs of a business slowdown. Missing filings are one of the simplest issues to avoid and one of the most common reasons states look more closely at an account. So how do you prepare for an audit before it happens? Preparation isn't something you start after an audit notice arrives, it's something built into your process as your business grows. Here's what matters most. Make sure you're collecting accurately. Verify that your platform or tax engine is configured correctly in every state where you have nexus. Audits can be much simpler if you address simple collection errors way ahead of time. Things like wrong rates, missing local taxes, and turning collection on too late are all avoidable and should be handled before an audit. Accurate collection is the foundation of compliance. Second, file consistently and avoid gaps. Filing consistently is one of the strongest indicators of compliance. Whether you file monthly, quarterly, or annually, avoid late filings, missing periods, and $0 filings when activity clearly exists. States pay close attention to filing patterns. Third, maintain clean, complete records. Strong record keeping makes the audit process dramatically smoother. You should keep organized copies of all sales tax data from the beginning of your business, including any sales made on marketplaces, invoices and receipts, filing confirmations, and exemption certificates. Businesses often lose older data when switching platforms or POS systems, so maintaining your own backups is essential. Fourth, keep your Nexus footprint updated. Your obligations evolve as your business evolves. Changes that can impact Nexus include hiring employees or contractors, opening offices or warehouses, storing inventory, including FBA inventory, and growing sales volume in new states. Review your Nexus footprint regularly to ensure your registrations and obligations remain aligned with your actual activity. Fifth, stay on top of exemption documentation and product classifications. While these issues don't typically trigger an audit by themselves, they become extremely important once an audit begins. To prepare, keep resale and exemption certificates organized and accessible. Maintain clear documentation for any tax-exempt or wholesale transactions. Understand which products you sell are taxable versus exempt in each state, and make sure your team knows how tax applies to your offerings. If you can't produce exemption certificates during an audit, states will treat those sales as taxable, even if the customer was legitimately exempt. And sixth, work with a sales tax provider who understands audits. A strong provider can play a major role in how smoothly an audit goes. The right partner will spot potential issues early before they escalate. Give clear, specific guidance on what records to save and how to store them. Review exemption certificates to make sure they're valid and complete. Communicate with the state on your behalf when appropriate. Help ensure your systems, filings, and collection settings stay aligned as your business evolves, and more depending on the complexity of your business. You shouldn't navigate an audit alone, and you don't have to. Sales tax audits may feel unpredictable, but the areas states tend to review are consistent. Filing behavior, reporting trends, missing returns, and visible indicators of activity that suggest nexus. This is why it's important to clearly understand how you're collecting sales tax, because some of the platforms you use to sell products do and do not collect on your behalf. If you're using Amazon, Etsy, or Shopify, you'll want to check out this next video to understand who does and does not collect for you. And remember, when in doubt, talk to a sales tax professional.